That $40 sneaker payment you split into 4, it could be sabotaging your credit profile harder than a credit card. And most people won't realize it until they get denied. Denied for an apartment, denied for a better auto insurance rate, denied for the first real credit card that actually helps build a FICO score. Buy now, pay later used to look harmless. Tiny payments, no big deal. In 2026, that story is changing fast. BNPL is moving from a budgeting convenience into a credit reporting and cash flow landmine, especially for Gen Z. And if you think it's only $10 every 2 weeks, stick with me, because the next number is going to make you angry. The Consumer Financial Protection Bureau has already warned that BNPL can encourage overextension, and the Federal Reserve has shown younger users are far more likely to stack these loans than older borrowers. That matters because your money doesn't care that the payments are small. Cash flow is cash flow. Miss enough tiny obligations, and your financial life starts cracking in places you didn't expect. And honestly, the real culprit isn't that Gen Z suddenly forgot how math works. It's that the system packaged debt to feel like a playlist subscription. Tap, split, done. No pain now, bigger pain later. So what changed? In 2026, more lenders, scoring models, and underwriting systems are taking a harder look at short-term installment behavior. Some BNPL providers have already been sharing repayment data more aggressively with credit bureaus. And even when the account itself doesn't show up the way a credit card does, the impact can still hit through missed autopays, overdrafts, bank balance volatility, and manual underwriting flags. That is the trap. Not just debt, borrowing power. I get why people use it. Rent is insane. Groceries are still elevated. Used car prices never really came back to earth the way people hoped. Wages went up in some sectors, sure, but not enough to make a 24-year-old in Dallas or Phoenix feel relaxed after rent, insurance, and student loan payments hit. When your checking account feels like a leaky bucket, splitting a purchase feels rational. It feels controlled. It feels smarter than swiping a credit card at 24% APR. But there's a difference between feeling in control and actually being in control. Inflation is still that leaky bucket. BNPL just puts pretty labels on the holes. I've done a version of this myself. Not with sneakers. With tech. I told myself a few small split payments were harmless because each one looked tiny. Then my checking account got hit by 3 autopays in the same week as utilities and insurance. I didn't go broke. I did pay overdraft fees and spent the month playing defense. That's when I realized the danger wasn't the purchase, it was the timing. And that timing problem is exactly where the math gets uncomfortable. Engaged. Think about the poor way versus the rich way to handle the same purchase. The poor way is not being poor. I hate that framing. The poor way is fragmented cash flow. You buy 4 things with 4 separate payment plans, each one small enough to ignore. Your bank balance becomes quicksand. 1 delayed paycheck, 1 higher utility bill, 1 forgotten subscription, and now a harmless shopping decision starts causing late fees, overdrafts, and possible credit damage. The rich way is boring. 1 purchase you can fully cover. Or you wait. Or you use a credit card only if the full statement balance is already sitting in your checking account and autopay is set to pay in full. Then the card becomes a tool. BNPL, for a lot of people, becomes an illusion of affordability. Why does this matter more in 2026 than it did 2 years ago? Because lenders are tightening in weird places. You might still get approved somewhere, but pricing is harsher. Insurance companies in many states are still using credit-based insurance scores. Landlords are using tenant screening models. Auto lenders care about thin files and missed obligations. A single 30-day late mark on a traditional account can hammer a young borrower's score. And even before a formal late mark shows up, unstable bank transactions can hurt you during underwriting when statements get reviewed. So ask yourself this. If your next goal is an apartment, a car loan, or your first rewards card from Chase, Capital One, or Bank of America, why would you let a pair of shoes compete with that? Why would you let a makeup haul or concert outfit sit in the same lane as your future borrowing power? Why does nobody explain that small debts can block big opportunities? There's another layer most people miss. Credit scores are not just about whether you borrowed. They're about whether your profile looks stable, predictable, and low risk. BNPL stacking can make you look the opposite of that, even if each purchase is tiny. Lenders don't care that the installment was only $18. They care that your financial behavior looks stretched. The Federal Reserve Bank of New York and CFPB research has pointed to BNPL users being more likely to carry other debt and experience financial stress. Translation: the issue isn't one loan, it's the pattern. And underwriting systems are built to punish patterns. I saw this hit my cousin the hard way. He had no maxed out credit cards, no giant personal loan, nothing dramatic. Just a bunch of manageable payments across apps, plus normal life bills. Then he applied for a decent apartment. The property manager wanted bank statements. What did they see? Constant small debits, low average balance, and zero cushion. He wasn't denied because he was reckless. He got flagged because he looked fragile on paper. That's a brutal difference. And if you're Gen Z, thin credit files make this even harsher. Older borrowers can sometimes absorb a mistake because they've got years of on-time history, bigger limits, maybe a mortgage, maybe a long-standing card from Discover or Amex. A 22-year-old doesn't have that armor. One messy season can define the whole file. So let me give you the paradigm shift in one sentence. BNPL is no longer mainly a shopping problem. It's a sequencing problem. You are borrowing against future cash flow before your financial foundation is stable enough to handle surprises. That is why it blows up right when adult life starts getting serious. Mini payment debt is like an escalator going down while you're trying to run up. You think you're moving because you're making payments, but your balance, your flexibility, and your approval odds aren't improving fast enough. Now I'm going to show you exactly how to flip this in 3 steps. Slow, practical, no fake guru nonsense. Step 1, build a BNPL firewall inside your checking account. Not in your head, in the account. Open a separate high-yield savings account, or HYSA, at a place like Ally Bank, SoFi, Marcus by Goldman Sachs, or Wealthfront. Name it upcoming bills. Then keep 1 full month of fixed obligations there as a buffer. Rent, insurance, phone, minimum debt payments, basic groceries. Why? Because the first danger of BNPL isn't interest. It's collision. Payments collide with real life. A high-SA buffer reduces that collision. If your monthly fixed survival number is $1,800, your first target is $1,800. Not $10,000, not some influencer emergency fund flex, just 1 month of breathing room. And yes, I know a high SA won't make you rich. That's not its job. A fire extinguisher doesn't grow your net worth either. It stops your kitchen from burning down. Same idea. People love to argue about whether cash is working hard enough. Your cash has one job before investing: keep you from making desperate decisions. Step 2, audit every split payment and convert chaos into one controlled payoff plan. Pull up every BNPL app you use: Klarna, Afterpay, Affirm, PayPal Pay in 4, whatever is on your phone. Write down the remaining balance, the payment dates, and whether autopay is linked to debit or credit. Then rank them by risk, not emotion. The riskiest account is the one most likely to hit when your checking balance is weakest. A lot of people attack the biggest balance first because it feels dramatic. I want you to attack the payment schedule that is most likely to trigger overdrafts, missed payments, or account instability. This is where most financial advice misses the point. The fastest wealth move is not always the mathematically highest APR move. Sometimes it's removing the cash flow tripwire that can wreck 3 other areas at once. And this is what even a lot of financial advisors miss about BNPL. The biggest cost may not be the loan itself. It may be the downstream price of looking riskier when you apply for something bigger. One insurance premium increase, one apartment denial that forces a pricier place, one bad auto loan rate. That can cost far more than the original purchase. Think human scale. If weak credit or messy bank statements push your car insurance up by $70 a month, that's $840 a year. If a landlord rejection forces you into an apartment that's $150 more per month, that's $1,800 a year. Suddenly that free $40 sneaker split didn't cost $40. It helped normalize a behavior pattern that can drain thousands. Step 3, build real credit on purpose, not by accident. If your goal is borrowing power, use products designed to build a file cleanly. That usually means 1, no annual fee credit card, low utilization, and autopay set to the full statement balance. Or a secured card if your file is thin. Maybe a credit builder loan from a reputable credit union if you truly need installment history. The point is to create signals the bureaus and lenders understand. Stable, predictable, boring. Keep utilization under about 10% if you can, under 30% at the absolute outside. Pay on time, never carry a balance just to build credit. That myth needs to die. Interest is not a membership fee for a good FICO score. Banks love that myth. Your wallet shouldn't. If you already have BNPL balances, I'm not telling you to panic. I'm telling you to stop adding new ones until the old ones are gone and your buffer is built. Freeze the apps if you need to. Delete the saved cards. Remove Face ID checkout. Make spending slightly annoying again. Friction is underrated. Convenience made you vulnerable. One more thing. If you're expecting a tax refund, bonus, or side hustle payment, don't blow it on catch-up fun. Use it to clear the payment clutter and stabilize your base. I used to think windfalls were for relief purchases. Now, they're for buying back margin. Margin is what lets you say yes to opportunities instead of begging your calendar not to betray you. This is the part nobody glamorizes. Wealth usually starts with fewer moving pieces, not more. Fewer apps, fewer payments, fewer surprises. Tense? Wealth usually starts with exactly 0. In fact, most wealthy people start with not even 1, but with debt. Thoughtful. I wonder if you know. Did you know that almost every millionaire in America built it from scratch? Odd. Take a second to think about that. 93%. 93%. That means every consultation you see on financial forums is likely from people who already had it easier than you. Analytical. Stop seeking financial advice from people whose personal circumstances are far different from yours. Slow, methodical pace. Understand how the structure of your life operates as an input mechanism. Excited? That means you can easily change any output by tweaking the input. Actionable steps. Remove all the fluff. Your online banking should be a single page. Every payment you create should be tracked on a specific platform. Tense. Your financial picture should be unequivocal. Analytical. The key is to efficiently track what's moving in, out, and together. Didactic. Write down all the costs of your business life. Whispering. Flow through all the costs. Encouraging. Do not let them blur onto one another. Motivational. A single-page overview can instantly change your life, instantly boost your confidence, and give you information to acquire wealth. Instantly.